Hello and Happy New Year. On behalf of the team at Cornerstone, we hope you had a wonderful holiday season. While the new year may be just another day or week to some, we use it as an opportunity to reflect on the prior year's accomplishments and challenges and evaluate what's on the horizon for the upcoming year. 2023 certainly had its fair share of challenges, but generally, there's a greater sense of optimism today than there was this time last year. Stocks rebounded and are back close to their all time highs. Inflation fell back closer to the target rate set by the Fed, and our lives returned to almost complete normalcy after a few years of unprecedented change. So naturally, this begs the question of, well, what do we expect in 2024? And honestly, that's hard for us to make any predictions on. So instead, we focus on themes, things that we believe will be driving forces, and follow the implications of those themes throughout the year. Our first theme: all eyes are on the Fed and the economy. The Fed has been laser focused on delivering a soft landing, which means slowing inflation without hindering economic growth. After a period of significant interest rate hikes, they pivoted sentiment in December, hinting at rate cuts in 2024. Currently, the market is pricing anywhere between 4 to 6 rate cuts, which we think is a bit much. We believe more that 2 to 3 rate cuts is more realistic, unless a soft landing is overcooked and recession becomes more likely. Regardless, we'll be intently focused on that this year and the Fed's pivot towards easing monetary policy, the speed in which they do it, and its implications on the market. Now, this potential for rate cuts leads us right into our second theme, which is a tailwind for the bond market. The amount of rate hikes and the speed in which it was done created a very difficult environment for bonds over the last 18 months. Much of that pain was amplified by the fact that stocks and bonds lost their low correlation characteristics and were down significantly at the same time. However, now, because those hikes, we are in a position where we can collect the higher yield, and future rate cuts could create an environment for appreciation on those bonds as well. And if a recession happened to become more likely, well, then bonds would be in a better position to provide that low correlation characteristics that we've historically experienced. Our final theme is obviously the presidential election. The election will dominate headlines for the next 12 to 14 months and likely start to cause a lot of frustration for many of us. Frustration leads to emotional responses, and we know that that does not mix well with investing. But what's the actual impact of elections on markets? Well, our partners at American Funds have done some pretty extensive research into this topic, and the research shows that generally markets don't perform any better or worse under either political party. That's not to say that certain legislative changes might not have short term impacts, but over the long term, markets trend upwards regardless of the party that's in political power. And in regards to actual election years, the primaries tend to create a bit more volatility because of the great uncertainty of outcomes when you have 10 or 12 or more individuals in the race. However, the markets historically perform better in the back half of the year, once you can price in the probability of just two potential candidates and what the implications of their administrations might be. With all that being said, we've been through controversial elections before. We've been through changing monetary policy before, and plenty of other complex situations. It's important to stay prudent in your plan, regardless of whether this year provides calm seas or lingering headwinds. As all of this progresses, we'll continue to provide our insights on these themes as well as others that emerge throughout the year. So, on behalf of the team at Cornerstone, we wish you a blessed and happy new year.